Perfect. Good morning, Bruno.
Hey Nick, how are you?
I'm good and you.
Good.
Good. So back for another episode of PLA, and today we got two questions. Bruno, I'll start with yours. So we've been dealing a little bit with structuring portfolios in our previous discussions with one another, and what I want you to touch on today with regards to structuring a portfolio, property portfolio, is just some of the tax considerations, the tax efficiencies that one should take into consideration when looking at structuring a property portfolio.
Investor protection when structuring any investment portfolio, especially property portfolios. Now, the next consideration is going to be tax. Now, when you're structuring your wealth, when you're structuring your investment portfolio, you're trying to get as best a tax position as you can. Now, the first thing that I need to say in this respect is please bear in mind that there are always going to be taxes to pay. So this concept or idea of tax avoidance altogether does not exist. And what is accepted as good practice is to structure your affairs in the way that suits you the best from a tax perspective without there being any question of evasion and without there being any question of avoidance. Oh, apologies. Now, sorry, guys. I did put it on flight mode. Somehow do not disturb did not work today. Apologies. So going back to what I was saying. So when we speak about tax efficiency and tax structuring, we want to make sure that we structure it in a way that's still acceptable to SARS. So there's never going to be a question of trying to entirely avoid paying tax. Now, there's different types of taxes that one needs to look at, and obviously you need to set certain goals for how taxation is going to take place. Now, your goals are normally set on a short-term versus long-term basis. So that's one of the first considerations is first you want to try and understand from a short-term perspective, are there any benefits? Are there any structuring benefits that you can rely on in order to make your tax position better versus long-term? What are the long-term tax benefits to make your position better? And then within these two different concepts, you look at the different taxes and you ask yourself, well, what is the best structure short term if we look at this tax type versus that tax type versus the other tax type? So now to just clarify what types of tax one generally considers. In your life, and even when you pass away, income tax is always going to be a reality. So any income being derived from any investment or any business or anything at all, you're going to be paying tax on, right? Simple as that. Companies pay tax, individuals pay tax, everyone pays tax on income that they receive. Now, another tax type comes in the form of capital gains tax. Now, capital gains tax is a tax on a specific gain on an asset of a capital nature. So if you look at properties as the best example, if you look at what you bought the property for versus what the property is now worth or what is being disposed for, and you look at that value and you can usually calculate a capital gains. Now that is an oversimplification though, because there's a whole bunch of other expenditure that is allowable that also gets considered in this gain. So you can actually make that gap a little bit smaller if you're allowed to add certain expenditure onto basically what we call a base cost, which is usually the amount that you bought the property for, the cost of the acquisition. It includes the certain costs in acquiring, so call it acquisition costs. So it would be things like the purchase price, the conveyancing attorney's fees, as an example, maybe a bond registration fee. So a couple of things that a person takes into account when calculating their base cost in order to calculate capital gain. And then your capital gain would now be typically the amount that you dispose it for or its market value, right? Now, why this is important in structuring, I'll explain to you a bit later, but obviously everyone that carries these assets will always be liable at some point or another for some form of capital gain. Now, the next one we start looking at are things, for example, like estate duty. So on the passing away of an individual, there's usually a duty or a tax that's levied on the individual's estate, and this is called estate duty. Now, estate duty only gets levied above 3.5 million rand. So this is what's normally what one normally calls a wealth tax, or people like calling it a wealth tax, because it's a 20% tax on any amount, net asset value of your estate above 3.5 million rand. So not everyone pays it. But if you've got a good, strong investment portfolio, if you've got a strong property portfolio, or if you're an aspiring property investor and you're looking to build up these assets and you're going to have assets of a great value, at some point or another, you need to consider that your assets and the net asset value after you pay off your bond may very likely be above 3.5 million rand. So you want to make sure that before you get into this, you've structured it properly. Because trying to change this around later, unfortunately, has quite dire consequences from a cost perspective. So now, bearing these tax types, and we're obviously not going to others. I'm not going to speak about things like transfer duty. I'm not going to speak about VAT and that sort of thing. I'm going to keep it basic just from a wealth planning and wealth management perspective. So now the next question is, how do we look at these tax types on a short-term basis? How do we look at them on a long-term basis, and what means what, right? Now, on a long-term basis, I normally start long-term because wealth planning should be about long-term. You can get certain benefits now, but if ultimately all those benefits are going to dissipate when you pass away, sometimes there's no real value. So let's start with long-term. So long-term value is only when you structure your estate in such a way that when you pass away, it carries the least amount of cost possible. Right? Now, remember, tax efficiency should not be your only goal. So this is very important to state, because if a person goes into their estate planning with only tax efficiency in mind, what will ultimately happen is you'll be creating a very rigid estate plan, which cannot easily be changed and may actually result in higher costs later when, for some reason, the tax legislation changes, given it's so dynamic. So what we want to do is we want to look at the basic principles of taxation and where the principles have hardly changed over a number of years. And we want to focus on these and align our strategy with these principles. So, for example, with estate duty, very basic principle, estate duty is only levied against the individual, right? Not against the trust, not against the company. We know this. This is unlikely to change. Now, given that, the logical conclusion is if you own properties in your personal name, there's going to be estate duty paid on it. If you have investments in your personal name, there will be estate duty paid on it. So what do we want to try and do? What's the logical answer to this? Don't have anything in your personal name. That's just an example. If you don't have something in your personal name, you cannot pay estate duty over it. So what does this mean? Do I put it in a company? No. Right? Because that's not going to do anything for estate duty because the shares are still in your personal name. So what's the point of that? You've got a property worth 5 million rand. It's in your personal name. You pay estate duty on 5 million rand. You've got the property in a company. The company's value is now 5 million rand. The shares that you hold are 5 million rand. What happens at the end of the day? You pay estate duty on 5 million rand. So what do you do in these circumstances? This asset should be held by something that is not you, but something that you do not own, right? And that is typically the trust. The trust you do not own. The trust, you might be a trustee, you might be involved in its direction, in its decision making, but you do not own it. It is not your piggy bank, it is not your alter ego. So by giving this property to a trust, or allowing the trust to buy the property, you're actually distancing yourself away from those assets and allowing the assets to be run in terms of the trustee. So that's just one example of the long-term benefits. Now, short-term benefits, for instance, involve how income is going to be taxed. And this really depends on an individual. And so an individual that wants the best short-term benefit, would look at their own tax rate and say, what am I paying in tax now? If you're only paying, say, 18%, you're right at the bottom, then maybe short term, it's beneficial for you to have the property in your own name. But as soon as this income starts going higher and higher, remember those tax brackets start being breached. And next thing you know, you're paying tax at 45%. Now you have to ask yourself, was it worth it? Because short term, it's sitting in your name, but you're at the highest tax bracket. And people with salaries experience this quite a lot because they work their way up their jobs. They do really well. And when they started, they've got this asset sitting in their personal name. But by now they hit the age of 40, 50, they've got a high paying job. And guess what? Now they're paying 45% on their rental income as well as their salary. So what do you want to do in these situations? You want to look at the different options. So if you look at a company, for example, a company is not taxed at 45%, a company is taxed at 27%. So there's one idea. You could possibly put it in a company and get it taxed at a lower rate. Yes, there are things like dividends tax that one needs to consider, but there are also other ways of generally getting money out of a company. So 27% for income that's going to be retained in the company is quite a nice idea, especially if you plan to reinvest this money later. But if you're not planning to reinvest money later and you want to use the money as it comes in, what some people sometimes do is they use a trust. And in this trust, what happens through the conduit principle is the beneficiaries of the trust that receive the income. So the money flows to the trust. The trust actually owns the property. The money flows through the trust, but it doesn't stop at the trust. The trust doesn't retain anything. The money simply flows straight through to the beneficiaries. And once that happens, SARS recognizes that the tax gets paid at the beneficiary's tax rate. And more often than not, you find that your beneficiaries of the trust are those that are dependent on that asset for survival. So you're trying to give them the money. You'd give them the money anyway. So you'd give your elderly parents money anyway. You'd pay for extra things for your kids above and beyond maintenance. You'd be giving this to them anyway. So why not give them the full income and let them be taxpayers if they ever get to that point, and give them the full income as it comes in? It's totally legitimate. The money flows through the trust, goes to the beneficiaries, gets taxed at the beneficiaries' hands. So these are just a couple of examples of reasons why people use trusts versus companies versus a person's individual name. So last point before I close off. So how does this all wrap up together? Remember that no one says that it can't be a combination of these. So you don't have to have a trust that owns the property and now you have to give all your money away to your elderly parents. So what people sometimes do is they will have the company own the property, but instead of the shares sitting in your personal name, you put it into the name of the trust. Like this, the trust holds the shares, the company trades, and the company draws income and pays tax possibly in the company's name and retains his earnings to build up future investments. And those guys that want to use it on a daily basis, well, one of the options you have is to put your property in a trust and utilize the rental income on a daily basis by distributing it to your children, allowing them to use it for their own needs.
Perfect. Thank you, Bruno.